Hello, everybody. My name is Lee Schwartz, and I'd like to welcome you to the second webinar in our exit planning series. Today's topic is understanding the role of valuations and due diligence for a successful transition. I noticed a lot of familiar names on the attendee list, and I know many of you attended part one of this series, and we're excited to continue bringing you this important information. So I know many of you are already clients of SVA, and we'd encourage you to reach out to your SVA contact if you have questions coming out of this. I'd also encourage you clients anyway, to share our contact details with other people you know who are looking to start the exit planning process, who could use our help. Now, if you're not a client and have questions, please reach out to me and I'll get you connected to a subject matter expert at SVA who can get those questions answered. So we're going to have a little bit of a different format today than most of our other webinars. Instead of a PowerPoint, we're going to do more of a panel with discussion around key topics. And the goal is to keep this interactive. So please feel free to ask questions throughout or provide experiences you'd like to share. Now, if you've got a question or a comment, please open up the chat box in Zoom and submit your question to all panelists. We'll also try to leave a few minutes at the end for some more general Q&A. And lastly, after the webinar, you'll receive a link to a survey. Please provide feedback so we know if you like this format or if you prefer more of a structured presentation. So today we're going to talk about exit planning strategies, specifically what's going on in the M&A market. We're going to discuss the due diligence process, and we'll talk about the role of a formal valuation in the process. And let me introduce our subject matter experts. Dan Glomsky is a CPA, is accredited in business valuation, and is a certified valuation analyst. He has his master's in taxation, and he's a principal in our Brookfield office. Nicole Grollup is a CPA. She's a certified exit planning advisor and is a principal in our Madison office. Now you can tell just from their designations, they spend a lot of time working with closely held and family-owned businesses and helping them through the exit planning process. So I'm excited to hear what they have to share. Welcome, Dan. Welcome, Nikki.
Thanks, Lee.
All right, so we're going to jump in here start off with some questions here in just a sec, but let's kick things off with a poll question so we can get a quick pulse on what's kind of our audience. So what is your estimated time frame for sale or exit? Less than a year, 1 to 3 years, 3 to 5 years, more than 5 years, or not sure? I'll give you a second just to answer. Okay, we're pretty widely, there's a wide range here. Okay, with our fewest being less than a year. So let's help, we can use that to sort of guide the conversation, guys. Let's start off talking a little bit about the M&A market. So everybody knows what's going on with the economy. It's been a crazy last couple of years, but Nikki, maybe let's start with you. What would you say is driving the success of the M&A market?
Lee, that's a good question, and I think that's multiple factors, which I can touch on most of them. So the low interest rate. So we've been in a low interest rate environment for quite some time now, but people are looking to, if given the opportunity, take advantage of that, especially if they're able to lock that in to get a better return on the business that they're looking to buy. And the stock market. So the stock market's really is really hot right now. So a lot of investors are looking at, hey, can I diversify outside of the stock market because they're not finding the investments to give them the returns that they're looking for. Tax reform. So tax reform brought tax rates down to a lower level, and now we're looking at the potential of those increasing even as early as next year. If you're following any tax items, there's a couple bills out there that we're watching closely. So taking advantage, maybe if they could do a transaction and get the best tax implications to do it now, knowing that it's likely going to go up. And another area is a lot of businesses with the labor shortage historically have looked at organic growth, and they're finding that a lot harder now. So they're looking at acquiring businesses as their growth plan versus the organic growth maybe that they relied on before. So I think that there's a lot of different factors that play a role in why the M&A market is so viable right now.
Yeah, Nikki, I agree. I mean, that what we're seeing in the M&A world is it's been crazy busy for the last 2 to 3 years. Certainly stepped up once the tax reform occurred. So I think there's a big drive from that perspective. I mean, if you look at, a lot of bank stocks, had a lot of tax liabilities on their balance sheet. And once the tax reform went away, their balance sheets improved dramatically. But it really means more cash flow for an investor to take something and do something with, right? So that's definitely been the case. It's, for our purposes, we've seen a lot of activity in it. It's slowed down a little bit here lately. I don't know if it's the apprehension of the tax reform, inflation, labor, there's a variety of reasons why it potentially could be slowing down, but it hasn't stopped, right? It's continuing on.
So we're seeing all this activity. Dan, who are you seeing as buyers in this market? Where are you seeing that coming from?
Yeah, so in M&A transactions, we see a lot of consolidators, people that are trying to, just get larger in size by making acquisitions. And what Nikki said was right on point, is that you have a situation where, people want to, the organic growth isn't there, so I'm going outward to get that growth, right? And that's how I do that. There's consolidators. There's a lot of private equity groups. There's a lot of private equity money out there where people are saying, okay, the stock market's been doing great, right? But I'm a little nervous that maybe it's not going to be so great in the future. I want to start to have my money working and try maybe even get a 20 or 30% return on my money. So I'm going to put more cash flow into these private equity groups. And then the private equity groups have a lot of cash flow to go out and make acquisitions. And then we have strategic buyers, right? These are buyers that want to, might be buying up one of their major supply chains, or might be a competitor, might be, some customer integration where they can see their growth by, being strategic or synergistic in their cost control. I don't know, Nikki, do you have any other ones to add, or you good?
Yeah, I've also seen the continued insider transfers to either family or key employees, and I'm seeing an uptick of that. And really, I think that a lot of that has to do with during the pandemic, a lot of these people needed to step up to get through it. So they really showcased their desire and their willingness to really help the business, and they gained such a deep understanding of the business that they decided, hey, if we can get through that, I think that we can get through anything. So I think that has a lot to play with it, but that will always be where a lot of transactions are related as well.
So let's think about the last 2 years ago. Helping somebody through this process might be entirely different than it is now, or even 18 months ago or 12 months ago. Can you guys talk, and Nikki, maybe if you wouldn't mind talk a little bit about kind of what you've experienced here recently, and maybe talk a little bit about how that's different than before?
Yeah, so I think the biggest thing recently is the timing of when to go to market. So a lot of business owners are a little nervous. Is now the right time given the pandemic? And maybe, some businesses were stronger coming out of the pandemic or stronger through the pandemic than others. So it really, those that hurt during the pandemic are really concerned about, well, is now the right time, or what does that look like? But regardless, is when you start this process, if you haven't already started, really you need to start this process, 2 to 5 years before you're even thinking of doing it. So even if now is not the time, there's plenty of work for you to do to increase the value of your business, whether you're selling to a third party or transferring to an insider.
Yeah, and I think to add on that, the process is the process, and we're going to cover some other things about due diligence and that type of thing. But the reality is, we get involved as kind of we know your accounting, we know your business, we know what potential buyers might be interested in looking for, and then trying to form, that entity package so that it looks the best for a potential buyer, and that you're going to be the most successful in getting through that due diligence process. And, the clients that we've had that have, started the process and then pull us in later, we got a lot of recovering to do, right? Either information's been disclosed that made somebody make the wrong interpretation. So then the discussion and value have gone a different direction, right? So what we like to do is holistically try to look at what that, what their business looks like, right? And how to reposition it for, what value do we put on it? How do we position its strengths? How do we, kind of diminish the weaknesses? So it's really a strategic process that has to, and Nikki's right. You really should start it 3-5 years ago, but sometimes it happens in as short of less than a year or 6 months. So we have done both.
Well, the good news is, based on the poll anyway, most of the people on here at least have some time in front of them, which is great, because you're right. I know we've done these before, and it's like a bunch of people are, all right, I'm ready to sell in the next few months, and that limits their options. So staying on the M&A side of things before we move on to due diligence, can you talk, Dan, a little bit about how understanding the M&A market as it is now, how that can help a business owner get the highest value for their business?
Yeah. So whenever I'm working with a client trying to say, okay, hey, I'm ready to look for a third party to buy my business. And when we do that process, it's like, okay, well, what does that market look like, right? Are you the right size where a strategic buyer might be interested in you? And what we have there is, years ago, I had a client that wanted to, they're operating their business and they made spinal implants. And what they kept doing is trying to keep increasing their revenue dollars so that eventually a Medtronics or a Stryker would be interested in them. So, so then their focus on bringing their value was, how much revenue can I generate? How do I keep driving that revenue dollar to get higher so that I am an interest to Medtronics or Stryker and so forth? Ultimately, they were able to get there, right? It took a different strategy than somebody just trying to, optimize their revenue, optimize their cost structure, and get that, really good EBITDA, because a company that's a strategic buyer isn't as interested in your EBITDA number, because they want to take that revenue and that's what they view as the golden nugget, right? So understanding your M&A market kind of helps you try to figure out how you should take your business and position it. If you're looking at a PE firm or maybe even a consolidator, right? They're interested in how you're doing from a profitability perspective, and so you want to really work on those numbers. And then maybe it's possible you want to make an acquisition yourself to change your size and possibly increase the multiples if you think you can do something and improve somebody else's business that you're acquiring. So when you're thinking about, am I going to go to market, you want to think about who your potential buyers are. And that'll help you kind of form where you go at your focus for your business. Now, at the end of the day, you want a nice, strong business, but there's certain things that I think become more priority than others.
Right.
Absolutely. And the approach, if you're going to sell to a strategic buyer versus if you're going to sell to, a third party, your approach is even different as well.
Right. And we're going to talk about succession towards the end, but all of these things are so interrelated. This is great. Okay. So I want to remind those of you who jumped on a little bit late, our intention here today is to keep this interactive. So if you do have questions, feel free to chat them in through the chat function in Zoom as you come up with them. Also, if you want to share something with the group, while not everybody can see what you chat in, I'm happy to share what you do. I'm also curious if you can share your experiences. I know we've been hearing a lot of business owners getting a lot of sort of unsolicited offers from PE firms or strategic buyers. So are you seeing an uptick in that? We're going to move on and talk a little bit about due diligence. And Nikki, let's start with a super softball question. What is due diligence? And did we just lose Nikki? I think we might have.
Oh.
All right, Dan, it's your softball question now.
So due diligence is the process of basically someone, buyer coming in and looking at what your, what does your financial statements look like? Is your income what you say it is your revenue what you say it is? Are your liabilities, all liabilities, or do you have some unrecorded liabilities? There's several components of the due diligence. It can be either, a financial due diligence, a legal due diligence where we're looking at leases, customer contracts, vendor contracts, and then it could be an insurance due diligence. What's been your insurance coverage? Do you have any outstanding claims? That type of stuff. But due diligence is really the process of having a buyer take a look at and make sure that what I'm acquiring, I'm knowing everything that's going on. And it's a very involved process. So it's not something that you want to necessarily take lightly, because a lot of people equate it to like an IRS audit or something like that, where they ask for all these documents and they're just keep digging and that type of stuff. That's what you got to be prepared for.
Okay, we did have somebody chat in, I think from I believe they're from a veterinary practice. They say they get a couple of people reaching out per week. So there's, I think those consolidators that you talked about earlier, Dan, there are a lot of them out there. Let's talk
just lead to that point. I mean, it's like I do a number of valuations for veterinary practices, and with the pandemic, it was so long as you can find the vets and that type of to do the work, right? There seems to be a lot more need for that, and I think it's a strong industry right now from a value perspective. So I agree. I mean, we've seen a lot of activities, multiple offers, unsolicited, right, on veterinary practices.
Okay, so let's talk a little bit about sort of the due diligence process. So why do buyers actually do due diligence? Can you talk about the reasons that they do those, Dan?
Yeah, so it's really a case-by-case example. So a buyer really does a due diligence on whatever they're trying to validate. So in a transaction, I could have an asset where somebody's just buying my assets. And in that case, the due diligence process is going to make sure I own all those assets free and clear. If if the buyer's buying the stock, then I'm more interested in, are the liabilities there? Do I have any, environmental concerns, that might draw me back in, and that type of stuff. So there's a variety of different things that the buyer will look for, but it's really to make sure that the assets that they got and they want are good.
Okay, well, we just went through all the topics and everything. We're wrapped up now. Thanks, everybody. I'm just kidding. So Nikki was able to jump back on. Sorry, we lost you there for a sec, Nikki.
Any participants might understand the blue screen of death, and the last thing you want during a webinar happens. So sorry about that.
Bad timing. All right, so Nikki, we're talking about due diligence, and I guess I'm going to throw you right back into the fire then.
All right.
So can you talk a little bit about, because I know you've been on the side of this, as the seller, what can you do to prepare for the due diligence process?
This is where you have so many opportunities, and this is why if you have enough time to prepare in advance, you're gonna get the best value. So really, pre-planning due diligence. So you're gonna go through your own due diligence on yourself. So the reason for this is you get to understand your strengths and you get to sell your strengths, but you also get to understand your weaknesses and rectify those weaknesses if you're able to. So during the due diligence process, they'll look at financial, non-financial information. They will look at every contract, probably even some contracts you didn't even know you had. And they'll really look and make sure that there are no undisclosed liabilities. There are, really that you have your ducks in a row. So before due diligence starts, when you're working with a buyer, you can really control what information you give to them. So you're going to give them, and you're going to give them in the format that you want to give them to them in. Once due diligence starts, then it's kind of, what they ask for, you have to provide. Well, you have to provide within some limit, but you have a lot less control over what your information looks like and what you're going to provide during that process. So if you know what your information looks like and you've had the opportunity to make any changes or tidy up some things along the way, you're looking at a smoother due diligence process, and you're looking to get the best value for your business.
And I think I want to add to that a little bit is a seller due diligence doesn't always happen, meaning, it's really an opportunity, as Nikki kind of said. And as a, we're going through the due diligence process. So just to step back one step. So when you have somebody comes to you and they want to buy your business or whatever the case may be, we put together usually some kind of sales memorandum or some kind of very surface information so that somebody can, say, okay, based on your financial results, here's the value that I want to make here's what I want to offer you for your business. And they send you an LOI. And a lot of people will go back and forth on that letter of intent. And in some cases, some sellers think, oh, we're done, we're just going to go to the purchase agreement. But that's when everything really kind of starts off in this process and the due diligence kicks off. So to the extent that, you're ready for that due diligence, what, you want to know how I control that medium. How do I always portray the values that I want to treat as my strengths? And then when my weaknesses do come up, that I'm ready to answer them, right? It's not catching me by surprise. I feel that as part of the due diligence process, we're involved in a lot of them. The more responsive you can be, the more, knowledge-based you can be in that process. It just kind of moves it all along. And I don't want to say people trust you better, because the reality of it is it's usually somebody that's hired to look at it, and they don't care about trust. They care about doing their job. So to the extent that you can answer their questions and get them comfortable that your answers are good, then they just kind of move through the process and say, okay, I'm not worried about that, right? So it's really an opportunity, and not a lot of people take advantage of it, but consider it if you're in that process. And Nikki's right. If you start looking at 2 to 3 years, 5 years ago, you can start shoring up some major weaknesses.
So maybe if you guys can maybe touch on some of those things that you've seen that maybe should have come up earlier but did come up in a due diligence process. Is there an example that you could share that has negatively affected a potential purchase price?
Yeah, so I have one example. So we had a client that was selling in, and the buyer was really looking at the revenue of the company because they wanted to, kind of show that they were larger in size. So they were very important in the revenue side. And we had some good data on revenue, but not great. So then we kept trying to have to build up those revenue numbers by customer contracts and deposits. It just created so much more work that if we would have had, better system of capturing who those top customers were, what kind of transactions we were doing, what were all the terms and so forth, that we could have maybe moved that process along a little quicker. And it resulted in not so much a reduction in the purchase price, but more so of an uncertainty in the process that's already very condensed.
Nikki, it sounded like you had an example.
I do. I have a couple of examples. So one is a business that had a bunch of verbal lease agreements for property. So that came up via the due diligence process and was a big problem for the buyer because they relied on this property in order to maintain the operation. So while it didn't necessarily kill the deal, it did definitely prolonged it. So it took a lot longer to get a transaction than it would have otherwise. And then another example I have is a business that they're during the property inspection, they found out that their facilities were not at the structure that they needed to be. And they would not have otherwise known if they didn't go through the due diligence inspection process.
Interesting. All right. And before we move on, we did have somebody chatted in a question. This is sort of going back to what we were talking about with unsolicited offers. And I know it's exciting, right? An owner gets an offer and that sure, let's take a look. Somebody asked, what are some strategies for dealing with cold call solicitations from potential buyers or brokers? Can you guys talk to that?
Yeah, from my perspective, a lot of times it's where the owner of the business maybe their mindset is at, right? Am I open to this or not? I usually want clients to be open from two perspectives. One, it kind of helps them sort out how committed I am to my business and what I'm doing with my business. And then two, if there is the right opportunity here, right? Is it the right one? And the problem with these unsolicited offers are they're usually very, inflated numbers, meaning that it's either a broker trying to get you to list your business because the market has been hot, right? The more sellers we can put in the market when there's a great amount of buyers, right? There's a big chance for commission and stuff like that. So you really got to look at people's motivations in this process. I would say that if it's a PE firm that's contacting you, a private equity firm, that one I would probably take a little more seriously if you're seriously interested about potentially, entertaining an offer. And some of these have the ability for you to roll over equity and continue to be involved in the business. So, kind of give it some thought as far as where you are in your commitment part of this. And then as far as dealing with them, I don't give them any information of substance. I might put together that sales memorandum. I also kind of go like I'm in the driver's seat, right? And kind of see how those terms of dictation go. And if it's just a bunch of friction, it's probably not the right, and you're not ready to sell, it's not the right thing to continue to pursue.
Great. Anything else that either one of you want to touch on in the due diligence portion here?
I think we're good.
Okay. So let's move on to the business valuations section, and we've got another poll question. Have you had a formal valuation performed for your business? Be interesting to see what we find out here, guys, because formal valuation is a little bit different than and we'll get into this, right? The back in the napkin conversation. So there you go, 80% of people have not had a formal valuation done. So let's talk about that a little bit. Dan, you've got all the letters behind your name. You do a lot of these valuations. Talk about how you actually determine multiples for a business valuation.
Yeah. So, you go on the Google and you grab the first multiple that comes to mind and you apply it to a number on your financial statement and we're done. I mean, this process is straightforward. But then all seriousness, that's what we run into all the time. It's like, well, what's the multiple and stuff like that. And the reality of it is a multiple is a component of the valuation process. And where I see the value of somebody like myself or a valuation being done on your business, we kind of go through the processes, what are your financial looking like? And we look at a historical period, and we also might look forward looking, right? Try projections and that type of stuff. But it really helps us try to understand, what your business is trending. What are some of your strengths within your business? What are some of your weaknesses? Where are you maybe not competing with your peers? And peers are always a difficult read anyway, because there's no real apples to apples. It's let's try to get the best comparables, but let's look at your historical data. How stable are you? How much growth do you have? And all these things play into it. And then when we talk about establishing a multiple is really a byproduct of what the valuation process does. So for example, what we'll do is we'll go through all those risks and we look at what kind of return somebody should expect taken on those risks. And that gives us what is called a cap rate. And that cap rate includes growth, it includes a size of your business, it includes, what kind of management structure you have, it includes some of your stability, it includes what the stock market's currently doing, it's what safe US Treasury bonds, it's all a combination of all those things, and that gives us our cap rate. And then we apply that cap rate to what we view as cash flow from the business. And then that'll give us a value. And then we kind of reverse engineer what that multiple will look like, right? So then if I have a value and I say, okay, my value is X, my amount of revenue is Y, I can then now calculate a multiple as it coordinates with revenue. Or I grab the EBITDA, how much is my earnings before taxes, depreciation, and amortization. And I can look at that and say, okay, that's my number. I divide it by my total value. That gives me my EBITDA multiple. And the reality is, there is a ranges for these various multiples based on people's industries and that type of stuff. But the multiple is really a byproduct of walking through what the risks that your business have within, what's available in the marketplace.
Dan, can you also touch just a little bit on, we hear valuation. Sometimes people say, I'm trying to think of some of the other terminology, but can you talk a little bit about the difference between, say, a full-blown valuation or a, maybe a lighter version? What do you see most companies are doing when they want a valuation?
Yeah, so the valuation world is, under my credentials, where you have the ability to kind of issue two types of reports. There's a calculation report, which basically takes an agreed upon methodology, and a valuation has a full-blown valuation really looks at three different approaches, similar to like a real estate appraisal. It looks at my cost or my net asset approach. It looks at an income approach, which is basically the cash flow generated by the business. And remember, a valuation is always forward-looking. So although we use historical data, it's the forward-looking that we're most interested in. So you could have great historical financial statements, but if the last 2 to 3 years are dropping off and I lost my biggest customers, well, I can't go back and grab those last 3-4 years ago, right? I got to stay in the current zone. So then we have the income approach, and we kind of look at that. And then the third is the market approach. What other businesses in your industry selling for? And there's where we have some of the multiple data, right? And we have access to that, and then we can further dissect what those markets look like and those transactions, that try to get them to apples the best we can. So some clients, so full-blown valuation will look at all three of those approaches. And for the most part, though, a calculation report would be sufficient, because the net asset approach might not be the appropriate, might not have a market approach. We might not have comparable market rates. So really can throw those two out onto the side, and then we're left with that income approach analysis. So what we do, though, is we still get into, what's your business? What's your management structure? We're again assessing all those risks within your business, and we get to know your business the best we possibly can. And I think it's a lot of clients thinking about their business as well, right? As I answer those questions, like I really never thought about who my top 10 customers were and what kind of contracts I have, or who my top employees and what are their responsibilities compared to the owners. There's a variety of different ways we go in this process.
Well, and you just touched on some of the factors, but Nikki, are there any other factors you want to talk about that sort of determine the business valuation?
Sure. I think one area that we could talk about a little more is EBITDA. So EBITDA is earnings before interest, taxes, depreciation, and amortization is what we use, and that's a historical number. So we're looking back at our historical financial statements. But what's important is oftentimes people will just take their financial statements and calculate EBITDA. What they're not taking into consideration are items to normalize EBITDA. Let's say 2 years ago you had a valuation done because you wanted to know what the fair market value of your business would be, or what the estimated value of your business would be. Well, that's going to show in your EBITDA number that you calculate, but that's not a recurring item, and that didn't enhance the business. So that would be a normalizing item. Other things to consider, and Dan and I worked on one not too long ago, would be, hey, are you paying above fair market value of rents, or are you paying below fair market value of rents for a property that you own in a separate entity? You might need to normalize those rentals. Same with officer or owner's compensation. Oftentimes for various reasons, your compensation is low or your compensation might be high, and that needs to be normalized as to what those costs are. So I think it's really important to take historical information. You need to spend more work with those financial statements and really dig into them and say, well, what is a normal number? And then that is used to predict what future will be, given a whole bunch of other non-financial items that Dan discussed.
So another question. Oh, sorry. Go ahead, Dan.
It's really important that you understand that it's just not so easy to take your EBITDA number and apply it 5 times or 3 times to it. That EBITDA number might be all like inflated, or it could be way too low, right? You might be giving away your business if you use an EBITDA number that has a bunch of expenses because I wanted to get all these tax write-offs, right? So you got to be very cautious on the numbers you're calculating and how you're really deriving at the value of your business.
All right, so I sort of where I was going with that, and I'm glad you said that, Dan, because one of the things we hear a lot from business owners is, hey, can I calculate this on just the back of a napkin, right? I mean, and Nikki, maybe you want to talk about like talk about the pros and cons of the back of the napkin approach.
Yeah, so that's probably the number one request or call, a big call that we'll get is, hey, what do you think the value of my business is? And, you just kind of have to push back and say, well, it's not that easy. So oftentimes, oh, hey, just give me a ballpark number. No, it's not that easy. We've talked about all these different components that go into what derives the value of the business. So can you calculate or even come close to doing a value any justice on a napkin? And the answer is absolutely not. Is you really need to take the time with your financial data and say, what is that normalized EBITDA? What unusual transactions have we had? For instance, there's a lot of businesses now that have received COVID funds or PPP funds or other grants. Well, you have to take that out of EBITDA when you're normalizing it, because that will not be anticipated into the future. So, and if you had those in there, it would give you a highly inflated number. So, so the answer is that at the very least, you need to go through certain steps to even get in the ballpark of where you need to be.
Yeah, and Nick, let me add a little bit on that. And I think one of it is a COVID related issue, right? So, we have COVID that, maybe we had a bad 2020, right? Or, and we're still recovering in 2021. We have this PPP money in it and these types of things that they kind of just mess up the noise of the financials. I'm in the process of doing a valuation right now where, we got COVID or PPP money, and, they're saying, well, we would have had those revenues, or we would have cut people and that type of stuff. And these are real discussions that think we have to evaluate. And the reason we have to do that is because a buyer's going to do that, right? A buyer's going to start to knock your numbers down. The buyer's going to try to say, well, your performance is a little uncertain because you had 2020's performance and stuff like that. So we got to prepare for that, right? And it's like, no, we weren't going to cut people, or we were going to cut people, or we missed out on revenue, or no, it all bounced back in 2021. And we know it's good sustainable revenue versus a recovery of some nature, right? There's a lot of analysis that has to go into that process to just say, I'm not taking EBITDA times a multiple and that's my value, because it could be high, it could be low.
And for the big part, I feel like there's a story behind it too. And you're crafting the story that you're going to tell your buyer too, of, hey, this is how we did and this is why. So I think that that's really valuable too.
And we've had a number of stories where it was like, just forget about 2020. It's not even going into the discussion, right? And sometimes those are discussed at the LOI level and saying, hey, you can make an offer on their business, or I might give them the sales memorandum with all the data except for 2020, right? Yeah. Don't even evaluate 2020. It's not gonna, if you want to evaluate 2020, it's, I'm not interested in selling you my business. It's all about controlling that story and putting the best story forward.
And we could have the opposite. We're seeing some businesses and some industries that are actually outperforming any other year, and what's the sustainability of that into the future? So I mean, you have to assess it on all ends.
Absolutely.
And Nikki, can you talk a little bit about the timing of evaluation? So we asked the poll question at the beginning. There was a pretty wide range of answers as far as when people are expecting to sell their business. When should they do evaluation? It's not right at the due diligence process, right?
No, so I would suggest that, maybe even you need to do it in components. So you need to get enough information to have a good understanding of your value. So you can first decide, do you want to sell for that as a business owner? Can you sell for that as a business owner? So we would never advise anybody to sell if it's not enough for retirement. The other thing is, if that value isn't what you want it to be. So a lot of times when we haven't gotten a valuation, we have a false impression of what the value of our businesses are. So then that gives you the opportunity to make changes and increase the value over the duration before you sell the business. So doing a business valuation at the beginning provides you the framework on what you're going to do in the next 2 to 5 years until the time when, your end stick is, and really make some changes that enhance that value.
And Dan, then would you say, knowing that you're doing a lot of the valuations, so let's say you do the valuation now, you're planning on selling in a few years. Do you have to redo that valuation entirely? Is that something you can refresh? How does that process work?
Yeah, so, that's a tough question. And the reason it's a tough question is because sometimes businesses change, right? And as a result of it, they might end up offering a different product line or go into a different industry and that type of stuff, which changes some of their stability, and maybe, the growth components increase dramatically. But generally speaking, once we start down the process of valuing a business, they don't change that much, where the updating process is that time consuming. But we always want to make sure that, that is the case. I can think of an example of one where, it was a company that, we would use historical numbers to calculate the future. Well, all of a sudden COVID hit, right? And they had to shut down a bunch of their locations. So they had no activity, but then all of a sudden their online sales just went through the roof, and it totally replaced above and beyond what those retail locations were. So then, it's like, okay, I got, I pretty much have the same or similar EBITDA number, but it's a totally different business. And I got a lot more customers I'm reaching. It just changed the dynamics of it. I will see, people that get a solicited offer, and they'll come to me and they'll say, can you tell me what my business is worth? Because they want to know whether that solicited offer is good or not, right? And there's times where I'll say, well, that's I would say that's a pretty good offer, right? Or I would say, no, that's not a good offer. But Nikki's point on whether you're ready to sell and there's enough cash flow that comes out of that sales transaction to support you is an important component, because alternatively, if I don't sell my business, I operated 4 or 5 years and I could get the same amount as I would have gotten in that purchase price. So there's things that you don't have to run to do it because you have the right offer. It's kind of all has to fit together.
All right, so I know we talked about this in the first webinar in our exit planning series, but maybe Nikki, can you touch briefly on, what businesses can do to increase the value of their business if they are preparing for a sale?
Yeah, so really looking about the sustainability and the accuracy of your financial information. So like we've talked about in the due diligence processes, we'll start to poke holes in our financial information. So really shoring up your processes and procedures and your financial reporting is a big one. Another big one that I work with clients on a lot is, how important are you as the owner of the business? And if you say, I'm pretty important, then I'm probably going to tell you that's a problem, because unless you're going to work for another 5 years, and some people have the desire to do so, or a lot of others do not, you have to have key management that's able to run your business without you. So that's an area that a lot of people need to work on. And again, I'm going to kind of stress this again, is that takes time. You aren't going to get your management team up to speed that quickly. So, so there's plenty you can do to increase the value of your business. And it doesn't really have anything to do with sales or expenses. It's processes and procedures.
Yeah, and as you said, hang on for 5 years, especially after a transaction as a business owner, can be really hard going from the boss to the employee.
Absolutely.
All right.
Yeah, in full disclosure, we don't, almost every transaction that I've been part of, the owner is generally speaking gone. If they make it a year, they could have a 2 or 3 year, employment agreement, but in most cases they're gone in 6 months or a year. So regardless of what the buyer tells you they're going to do, it's different.
Absolutely. Well, good. All right, let's move on to our last section. This is going to be on succession. So last poll question is, who do you anticipate transitioning your business to? A family member or family members, an internal buyer or existing management, external sale or third-party sale. We haven't touched about this a lot yet, but an ESOP, employee stock ownership plan, or not sure. Okay. Well, there you go. We've got a lot of not sure's, but the overwhelming majority of people who know are looking at a third-party sale. So interesting. So let's talk a little bit about succession. Obviously, we work with a lot of closely held and family-owned businesses. Nikki, how important are the last 3 topics if you're going to transfer within your family? Does any of this even matter?
It does matter. So as far as due diligence goes, it matters. You don't want to hand over liabilities to your family members, or I hope you don't, because then we're probably not in a good succession anyways. But also it depends on how closely your family member is working in the business. How much do they know? So they might not know much about the owner type responsibilities of the business. So they're still going to want to and need to undergo a due diligence process. The other thing is the valuation component. So if you're selling to a related party, you're going to need to sell it at fair market value. So I'll get the question a lot of times, well, can I just sell it for a deep discount? Well, at that point, the IRS is going to look at it and say, well, we have a gifting component to this transaction because you didn't sell it at fair market value. So you're going to need a business valuation in order to substantiate that you're selling it at fair market value. Or if there's a gifting component, you're going to need a business valuation in order to support that gift.
Okay, a lot to think about if you're transferring it within the family. So Dan, maybe staying on the succession topic, what are the benefits of knowing the M&A market if you're not going for an external sale?
Yeah, so, obviously I'm in the valuation world and stuff like that, but I also believe that it's important that you kind of understand what's happening around you. And, it's a lot of things, are you seeing a lot of, people being consolidated in your industry? Are you seeing, a strategic buyer? So I have a client that's going through a transaction now where they were approached by, in essence, a consolidator, somebody that was buying up all his competitors. Well, eventually they're so much bigger than he is, right? And to the point where his leverage and maybe his market share start dwindling, right? So not being aware of what's happening around you can, all of a sudden be a reality that I just lost value here because I didn't do something, right? Maybe I should have been out making acquisitions. Maybe I should have been communicating with these consolidators. Maybe I should have considered selling to somebody despite my time frame, right? So understanding that M&A market and what's going on in your industry or your business is, I consider to be very valuable, because it's no different than looking at your competitors and seeing what they're doing.
So when we started this section, we asked the question, what do you think you're going to do? But our biggest answer was not sure. Nikki, can you talk a little bit about how do you start to navigate this process? There's a lot of options here. How do you work towards 4 or 5 different options? How do you figure out the solution?
Yeah, that's a good one. So the number one thing that I'd say is you sit down and you write your objectives. What do you want out of the sale of your business? And I'll tell you, it will vary by every single business owner, and that's okay. It should. So some people might, they might write down, I want my key employees to have a job, or I want my business to be in the same location. Another person might write down, I want to maximize value. And those are all okay. Those are all exactly right. But how you plan for it and how you proceed it and who your buyer is are all dependent on those key objectives. So as you're going through this process, or if you get an unsolicited offer, these objectives really help you stay true to, this is what I want to happen with my business. And every decision you make, you can say, does that fall in line with where I want the business to go? So that would be my suggestion for where do you even start? And then, a lot of people might say, working with a client who decided that he wanted to sell it to his employees, but then the employees, actually, given where they're at in life, decided they didn't want it. So good thing that they went and they expressed what their intentions were in advance. So now they have time to go to a third party.
We just had a question come in about ESOPs. So just asking to explain what they are, which is great. And we probably should have thought about that ahead of time, because we've been hearing more about ESOPs, right? So can one of you explain, give a brief overview of the pros and cons of the ESOP model, or give an overview of it?
Sure. Yeah, so an ESOP is an employee, it's kind of like basically where you're having the owner of the company sells to an ESOP, which is basically, here's where I have the employee owned companies, right? And so the ESOP in essence is a retirement account. so they don't pay any taxes, right? So and then what happens is the company continues to grow in value in that ESOP, and as people leave the organization or people retire, they receive those as if it were a regular retirement account, and that's where the government gets its taxation on the value of those particular businesses. So the reality of it is, and what will happen in an ESOP is the company will be valued. They'll go to the bank, they'll get financing to make the acquisition from the owner. And then that ESOP, in essence, has that loan, right? And that offsets the value. So initially, the value of an ESOP is relatively small because what I have is a company that's worth X and a debt that's worth Y, and there's not much value to begin with. But over time, that debt's paid down and that value of the company continues to increase and so forth. So generally speaking, that's what an ESOP is. We do see a lot of traction in it because of the tax advantages of it. But you still need to have management and structure. It's not like, people have to watch over it and protect that asset. And so it, really requires somebody being committed to that process. A lot of times we'll have an owner that sells it to an ESOP and just continues to operate it as such. And, they have taken their money off the table, but they still have a vested interest in keeping the employees and everybody going. And then they could sell eventually to a third party, right? And so then that ESOP in essence goes away and everybody rolls their funds into another retirement vehicle.
And ESOPs they have gained a lot of attraction over the last several years. A lot from the tax strategy as well. But part of the thing that you need to think about for an ESOP is they are complicated. So you aren't just gonna start up an ESOP. You're gonna incur significant costs on the front end. So there is a right size of business that fits within ESOP. So if you're too small or you're too big, it does make it a little hard to make an ESOP work. And you need to go into it knowing that there are pretty significant costs up front.
Okay, so we did what we said we were going to do. We've got 8 minutes left. We've got a few minutes for Q&A, so please chat in any questions that you have. We did have a couple more come in, one of which was very specific, but we kind of touched on this a little bit. But one of the questions was, I know I'm selling to a family member. Should I get a valuation?
Yeah, so let me answer that. One is I'm a believer that you should always know what your company's worth, right? How do you determine whether you're strengthening your company or positioning yourself? Because you can keep sending it on to the next generation. We're seeing not the next generation not necessarily being interested in taking over, right? So that eventually could end to the point where you don't know where you're going to go and you're going to need to go to a third party. So you need to know how you kind of are growing in value. And when you go back in value, when you maybe take steps backwards. So, I think you have a fiduciary responsibility to kind of always know what that value is. Now, do you need a full-blown valuation? Maybe not, but we really should talk about how you would value your business and how do you gauge on how you're doing. So, because like I said, you want to know what the market's doing around you. You want to make sure that you're not creating weaknesses, that we're trying to strengthen your organization. You always want to be in the strongest position that you possibly can be, knowing that what's in your control and what's not in your control.
I think you also need to consider, is it going to be seller finance, or are you financing it, or are you going to go to a bank? So if you go to a bank, they might require a business valuation to be done. So you want to know that up front as well, and what business valuations will they require? So you can kind of all get it done and satisfy all needs if that's the case.
Okay, so another question that just came in, you were kind of just touching on this, Nikki, but I've got great managers, but I don't think they're in a financial position to acquire the company. What are my options?
Yeah, that's a good question. We get that a lot. So part of it is, can you structure it do you want to structure it as a seller finance, and then they use the earnings from the business to pay you out over time? Another option is the ESOP. Would an ESOP be a good option for you? Or Are they not interested, or is that really, hey, so a lot of times I'll hear, hey, I just kind of want to cash out and be done with it. Because if you don't cash out, then you have a note, you're still at risk. And how much risk do you want to leave on the table? How much do you trust those key employees? So part of it is, some sellers will say, hey, I don't want to do that. And I want kind of an all cash deal, and a third party is going to be where you would go with that.
Yeah, and we'll see situations where, ultimately they sell to a third party, and the management has employment agreements, right? And maybe the management team's also part of that process as far as selecting it. Sometimes there's rollover equity, and we, might, give them a bonus of, whatever, and they take that bonus number and they roll it into the company that's acquiring to kind of form that connection, right? But yet also, make them part of that process. There's no right or wrong answer in a lot of this stuff. It's really facts and circumstances. Everybody has their own little, things they want to make sure are protected. Some people want to make sure they keep getting rent. There's a lot of motivations that we have to kind of blend in here. And but what I am saying is that I think there's always a solution, right? And we just got to think through what we're trying to accomplish, and then our paths to get there.
All right. Either one of you have any parting words before we wrap up? We're almost full to an hour here.
No, I'm good. I think, I've shared, a lot of stories and a lot of things that happen. And like I said, we do a lot of these, and no two are the same. Each client is different. Each transaction is different. Each business is different. So it's just a matter of going through a process and asking questions and really trying to get people to discover where they're at.
I would say really sit down and, take a half a day working on the business and write down what your objectives are as far as what a sale looks like for you. What do you value? What don't you value? And that will really lead the whole process for you.
Great. Well, if anybody on has additional questions, feel free to reach out to Nikki, Dan, myself. Just as we wrap up here, I'd like to let you know that you can visit SVAaccountants.com, where the recording of this webinar will be located, as well as e-guides and articles and past events, upcoming events. Part 3 of our exit planning series will be on December 8th, and the topic will be how to minimize tax implications with estate and tax planning. And again, please complete the survey and provide feedback on this format. We'd like to know if everybody wants to continue this, or if you like the more structured format. We are offering an Amazon gift card to those of you who complete the survey. And we are open to criticism as long as you compliment my moderating skills. I'm very fragile, so please be kind. And I just want to remind everybody that the SVA team is only a phone call or an email away. So if you're a client, reach out to your SVA contact as questions arise. And if you're not, please reach out to me and I can get you the help or the answers that you need. Thanks again for joining us today. Have a great rest of your day, and we hope to see you at our next webinar on December 8th. Bye-bye.
Thanks, everyone.